Hello everyone, and welcome to this bobsguide webinar. I am Neil Ainger, the Editor-in-Chief of bobsguide. And the subject for today's webinar is AIFMD reporting, getting ready for 2014. We'll be explaining what the EU Alternative Investment Fund Managers Directive, the AIFMD of the title, is, the short time frame for implementation, and how it is going to impact the market, the technology infrastructure and ways of working in the shadow banking, derivatives, hedge fund and private equity arenas. The risk and reporting obligations facing institutions will be detailed alongside what needs to be done to get ready for next year. We are very happy to be running this webinar today with our sponsors Axiom and the excellent guest speakers from PwC and the Alternative Investment Management Association, the AIMA. Now, the wide-ranging discussion today will touch on the mechanics of the new obligations, how it will impact data, how it fits in with other regulations, and the international non-EU perspective, and much else besides. There will be an opportunity for interactive questions at the end of this hour-long presentation as well. So to introduce our speakers, we'll be hearing shortly from Jennifer Wood, who's the Head of Asset Management Regulation at the AIMA, who will provide an overview of the EU directive, its background, time frame, and so on. And then we'll hear from Benjamin Gauthier, who's a director at PwC, and we'll discuss the operational challenges, connectivity, ESMA's guidance, and so forth. Our last speaker today will be from our sponsors, and that's Bruce Runciman, who's the Senior Vice President at Axiom, who will address the technology issues and how the marketplace is likely to change. Before we go any further, however, there are a few housekeeping points I'd like to raise. If you have a question to ask our speakers, please go to the box on the bottom right-hand side of your screen and simply type it in. I'll use it at the end of the webinar today, time permitting, during the Q&A session at the end. Okay, so the entire webinar will also be recorded, so if you miss anything or think a colleague might be interested later on, you will be sent a link to the recording. Without any further ado, I'll hand over to our first speaker today, who will be providing an overview of the regulation. So, Jennifer, over to you.
Thanks, Neil. Good morning, everyone. My name is Jennifer Wood. I'm the Director and Head of Asset Management Regulation at AIMA, and I'll be giving a little bit of an overview today of the requirements of AIFMD and leading into the reporting obligations. Very quickly, running through this, the AIFMD entered into force in July 2012, and member states had until 22nd of July 2013 to transpose the directive into national law. As of the end of September, 15 member states had met the deadline. Most member states also adopted transition periods, all of which will end by the 22nd of July 2014. EU firms that want to manage or market funds in Europe have to be authorized, and non-EU firms that manage funds that they want to market in Europe will have to comply with national private placement regimes, each of which is required to impose certain minimum requirements. When thinking about the AIFMD and whether you need to comply, there's some key questions. Do I want to market an alternative investment fund, an AIF, to European investors? We'll look at what constitutes marketing, whether a fund is an AIF, and whether your firm is an AIFM, an alternative investment fund manager. Another key question to ask is where the entity that's primarily responsible for portfolio management and risk management is located. The key answer to some of the questions. And then a couple of issues around delegation, about whether you want to engage a European asset manager to do portfolio management or risk management, or whether you want to provide portfolio management or risk management as a delegate in respect of a fund managed by a European asset manager. Marketing is the direct or indirect offering or placement at the initiative of the AIFM or on behalf of the AIFM of units or shares of the AIF it manages to or with investors domiciled or with a registered office in the EU. It's important to note that this will also include any indirect offerings, so through a placement agent or through other activities such as the use of consultants or cap intro teams. Depending on whether the member state definition of what the member state definition of domicile is, you may have to be careful about marketing to investors even outside the member state, because sometimes activities outside the member state will be considered to be marketing in the member state. Placements that are made at the initiative of the investor don't constitute marketing. Those are called reverse solicitations. And individual member states are going to differ over the scope of what marketing activities are included and not included as reverse solicitations, and therefore outside the scope of AIFMD. An AIF is a collective investment undertaking, including the sub-funds, other investment compartments, that raises capital from a number of investors with a view to investing in accordance with a defined investment policy for the benefit of the investors and isn't a UCITS. The AIFM, the Alternative Investment Fund Manager, is a legal person whose regular business is performing at least portfolio management or risk management for one or more AIFs. Without either of those activities, that's not the AIFM. Anybody who's doing portfolio management or risk management can be the AIFM. The AIFM can be either an external manager appointed by the AIF, as long as it's required to do portfolio management or risk management, or where the legal form of the AIF permits internal management, it can be the governing body, and they can choose not to appoint an external AIFM. For non-EU AIFMs, they may be able to market in the EU under national private placement regimes. Not all member states are going to have one. The marketing under the NPPRs has some requirements that go with it. Compliance with transparency requirements will be important. Those include annual reports, disclosure to investors, and regulatory reporting, which we'll come on to in a little bit. There also has to be a cooperation agreement in place between the country of the non-EU AIFM and the country where the non-EU AIFM is marketing, and the third country where the non-EU AIFM is domiciled can't be listed as a non-cooperative country or territory by the Financial Action Task Force. For EU AIFMs, there will also be an ability to use private placement for non-EU AIFs, so for a Cayman Islands AIF or a U.S. AIF. But they also have the opportunity to use what's called a passport to market European funds, your EU AIFs, throughout Europe without having to use the national private placement regimes. EU AIFMs are also subject to additional requirements beyond the transparency and reporting requirements that are applicable to non-EU AIFMs. Those include capital requirements, remuneration requirements, conflicts of interest issues, valuation, and the requirement to appoint a depositary who will have strict liability for lost assets and have to monitor cash flows and oversee activities of the portfolio. In terms of regulatory reporting obligations, AIFMs are required to regularly report to either the competent authority of its home member state or to the competent authority of each member state where the AIF is marketed. For a EU AIFM, they only have to report to their home member state. With respect to EU AIFs, they might have to report under a national private placement regime with respect to any non-EU AIFs that they market outside the home jurisdiction, and then non-EU AIFMs will be required to report in each member state where that AIF is marketed. The reporting is required to provide information on the main instruments in which the fund is trading, the markets which it's a member or it actively trades, and the principal exposures and most important concentrations of the AIFs that it manages. The reporting obligations are tiered and are dependent on the level of assets under management, and they can range from requirements of being quarterly, half-yearly, or annually. Annex 4 of the Level 2 regulation provides the template for reporting, and the AIMA guidelines provide some further instructions. AIMA published its guidelines on October 1st, 2013, and they included a variety of information, details around the reporting obligation. The guidelines are applicable from 2 months after the translations are published, and reporting periods have been aligned to the calendar year. The first reporting period will be the first full period after the AIFM has information to report, which generally after it's notified that it's going to be either authorized or making private placement in the jurisdiction. In addition to the October 1st version, AIMA has published 2 further bits of amendment to their guidelines, principally the underlying technical detail. One was on 15th of November, and then a second further technical revision on December the 4th. At the same time that they published the guidelines, they published an opinion because there were a variety of items that they had proposed in the draft guidelines that commenters noted could not be supported by the Level 1 text in terms of AIMA's ability to impose those requirements. So what they did was they recommended to member states that they should take up certain additional requirements, such as reporting of VAR, reporting on high-frequency trading, and information on geographical focus. Those issues have to be taken up by each member state. So we come to our first poll question. The question is, how prepared do you think your firm is in meeting AIFMD requirements? Are you fully prepared, somewhat prepared, or not prepared at all? You should see the polling questions on your screen. I'll give you a few seconds to select an answer, and the answer will show up once that period is over. AIFMD reporting will be similar to Form PF, but isn't identical. There are some differences. Everyone files. There are some non-overlapping data points, so the same topic is covered, but maybe in slightly different words or slightly different AUM calculations. The leverage reporting is on a gross basis and a commitment basis, with additional disclosure if you're employing leverage on a substantial basis. Substantial basis is 3 times or more leverage. There aren't very many instructions about the detail of it, although there is an XML template, and master and feeder funds have to be reported separately. The data will have to come from various sources, including the manager, the custodian, the administrator, and the transfer agent, and the deadlines are very short, generally within a month of the period end or 45 days for funds of funds. I spoke earlier about the tiering based on AUM. So AIFMs with more than €1 billion of AUM, it's calculated in accordance with the AIFMD and Level 2 regulations on a gross basis, so taking into account the notional value of derivatives, for example, on a gross basis, will have to report quarterly, and others may be able to report semi-annually or annually. Multiple filings are going to be required if you're privately placing, and each member state is able to add additional requirements. There is no centralized one-stop filing place for AIFMs, so that information will have to be filed with each individual member state rather than with a central authority like AIMA. Information that is filed will be shared among the member states, and firms that are already authorized will, in certain circumstances, have to begin reporting in the first quarter of 2014. Member state readiness to accept reporting varies across the EU. One example of a requirement is that from the 1st of January 2014, the UK Financial Conduct Authority, the FCA, will be in a position to receive reports using the XML version 1.1 reporting template that AIMA published with the final guidelines, and eventually they'll transform that into their own reporting system. We expect other member states to do something fairly similar, although that, again, will vary from member state to member state. So with that, I will turn over to Benjamin.
Thank you, Jennifer. Based on that here, I think that we all have a quite detailed overview of what are the things to consider for AIFMD. So now what I suggest is to go for the related operational challenges. So trying to illustrate what are the technical things that we have to consider there to go a step further and be able to do this reporting in the context of AIFMD. So just to tell you who I am, so I'm director in PwC Luxembourg. I'm working in the advisory team where actually I'm working on two main aspects. One is risk management, the other is reporting for AIFMD, and there are a lot of connections between risk management and the reporting into AIFMD, so that's the main reason why I'm involved in these topics. And I've been supporting several clients till now in the implementation of these requirements for the reporting. So that, based on that, I would like to illustrate with you some of the key challenges that we're identifying. So the first thing related to the reporting is today we are really concentrating our presentation on what is disclosed on the slides that you can see for the moment, which is highlighted in red, which is reporting to competent authorities. One thing that we should not forget is that actually there are additional requirements in terms of reporting in the context of AIFMD regarding the annual report and also the disclosure to the investors, where actually they need to be provided with a certain numbers of information before they do invest in the different AIF. And also, they need to be provided with a certain numbers of information on an ongoing basis, like information on leverage, changes on the way liquidity management is done, and things like that. So then we, of course, have the reporting to competent authorities, which is clearly the one which will be the most difficult to manage from an operational standpoint. So you can see that we have put different level of challenge there, moderate for the annual report, high for disclosure to the investors, and very high to reporting to competent authorities. The main reason is that it will involve quite a lot of people. It's requiring a lot of data, and in terms of tools, you will definitely need dedicated tools to do that. It won't work with an Excel file, except if you have only annual report to do just for one AIF, maybe being a PE or real estate, maybe that could work. But if you go to a structure where you have several AIF, having hedge fund style or would say usage like, this is clearly something that it would generate challenges from an operational standpoint, and you would need tools to support you there. So that's the background. Now, unfortunately, the format is not exactly the one that I had, but anyway. So here, what I want to say, as it has been probably mentioned by Jennifer before, regarding the level of asset under management, this is the trigger for the frequency of the reporting. So can go from once a year to actually 4 times a year, so quarterly report. And then this reporting on a quarterly frequency can be quickly reached, because it's when you have above 1 billion of asset under management at the level of the AIFM, so meaning that this is the sum of all the exposure that you have at the level of the AIF, the AIFM is managing, so quite quickly reach, then you will have to go for quarterly reporting. So just the fact that actually it's on a quarterly basis will generate a challenge in terms of operations. Now, a second point that I would like to raise is the fact you can see at the bottom of the slide, bottom right. So you have the reporting, it's bottom left, sorry, reporting content, and you have 24.1, 24.2, 24.4. So here, actually, this is making a reference to the directive, so the AIFMD, and there are three main articles that are related to the reporting. And these requirements, or these paragraphs that are included in the directive, have been converted by the AIMA into reporting structures, which is actually an Excel file where you have all the fields that need to be populated. What is making this 24.1, 24.2, 24.4 quite important is that actually 24.1 will apply to any AIF, any AIFM. As soon as they are in the scope, then 24.1 will apply. So this will generate a first level of requirements in terms of data. Then you have 24.2, which only apply to, it applies to all AIF, except those that are non-EU and not marketed in the EU. So then you have this 24.2 that will only apply in certain situations. 24.4 will only apply for the AIF that are having high level of leverage, which is basically a leverage level above 3 using the commitment approach. So meaning that everything that is hedging and things like that can be removed from the computation. So, but if you're above 3, then there's additional information to provide to the regulator. So that's the first point I wanted to make also, is that here there's different degree in terms of content that will need to be provided to the regulator depending on who you are, basically. So, here I have first questions. So what are your top concerns for the next 12, 18 months? So we have meeting regulatory deadlines, reducing operational risk, managing cost, depository liabilities, or increasing data transparency, developing a shadow accounting model. So this is the point that now will be raised in the poll question. Thing that I can continue during when you're answering. So in terms of operation challenges, you can see here on this slide, so slide 25, that actually at the AIFM level, there's approximately 35 data fields that are required to be able to populate the report. At level of the AIF, of course, here we have used 24.1 and 24.2. You have approximately 300 data fields that are required. So numbers are increasing quite fast. If you have private equity, you have 20 data fields that are dedicated to you. So if you're in that specific area, then there are specific reporting requirements that are applicable to you. And then, as I've mentioned before, if you are highly leveraged, then there's 20 data fields that have to be considered on top of that. So different operational challenges there. First of all, you can see that there's quite a lot of data together. So this is a first layer, I would say. Then there is a second point to consider, which is the fact that only one source cannot provide all the data that are required to populate these reporting requirements to the regulator. So you will have to connect with, on average, we expect to have 5 counterparties, being mainly the AIFM, probably fund managers or portfolio managers. Then we will have the risk management team, more than probably the fund administrator or fund accountant, and then the custody. So at least 5, and then it can quickly increase depending on your setup, if you have several in portfolio manager or that kind of things. So that's a second thing that I wanted to say. Another one, which is, how will you get some of the data? For just as an example, there is a field which is called reapplication rate of collateral. There, actually, what the regulator is expecting is to see what is the percentage of the collateral that you've posted with your counterparty that is actually reapplicated. That's probably an information that will not be directly easy to get, because it will be actually with your counterparty. So let's just see how this information can be collected. And that's just one example. Another point which is quite important, which is who is going to do the computation. Because to populate these fields, there are quite a lot of aggregations that needs to be done. Let's just talk about concentration by countries. You need to look at your portfolio, doing the aggregation, then sorting the results. For example, for the top 5 counterparties or something like that, you, on top of aggregating data, you need to sort them and to show what is the biggest concentration that you have. So the question is, who's going to do the computation? Is it, for example, one of the stakeholders, being the fund administration or the AFM or something like that, or is it the entity who will take the lead on the performance of the reports, who will do the computation based on raw data provided? So that's something that needs to be clarified. Then you have to think about the potential for having transparency back in time. If at some point you have questions raised by one of the regulator or the AIMA or someone like that, saying, how did you end up with such results? If you don't make sure that you're able to go through the whole reporting structure back in time, maybe you can face issue. Then you have points like distribution, because if your fund is a non-EU AIF distributed in the EU, as it has been mentioned by Jennifer, then that would mean that you will have to provide the report not only to one regulator, which is the case when you have an EU AIFM, but if you don't have any EU AIFM and you have non-EU AIF distributed in the EU, then that means that you will have to provide this report to any regulator where you're marketing your AIF. Then there's a question, if you're meeting that kind of situation, in terms of format. Will they apply all exactly the same format? It seems that yes, because that's the expectation from the ESMA. But on the other hand, we know that there is an opinion circulating where actually each local regulator have to define what they want to apply there. Value at risk is an example, which is a recommendation from the ESMA, but it might end up with a situation where some regulator wants to see it, some others are fine if they don't have it. Then in terms of providing the information to the regulator, for example, the UK are saying that they're ready, so FCA, but they're asking to send it by email, while actually in Luxembourg they are thinking about using an automated transfer using XML. So then we have question on that. We can also raise questions related to interpretation, because some of the fields are subject to interpretation, especially considering that we have some details, but not to the very last detail. Of course, the final question, based on all what I've just described here, is what is the opportunity to have a full automation of the production of this report? This is key if you want to be able to populate that on a quarterly basis and send it to the regulator, and also limit the operational risk. But on the other hand, what is the capacity to go for full automation, considering that you will have something like 5 stakeholders, 6 stakeholders in that production? You can have, for example, the risk management team, which is providing information. Do they have systems that are completely integrated so that actually you can go for full automation? I don't think that it will be the case in the first stage. So clearly we can see here that there are operation challenges. Now, in terms of hot topic, there has been a lot of debates on what the grandfathering applicable for the reporting to the regulator. Actually, at first, the ESMA tried to say that it was due by the end of January of 2014 for all entities. Then in the final guidelines, they said that it should be aligned with the filing of the AFM. So that means that now, depending on when you get your license, the quarter that will follow the licensing period will be the one where you will have to prepare your reporting for the regulator. But then there are differences between regulators. Some want to apply fixed deadlines, which is the case for the IMF, it seems, or at least based on the documents they published early November. Then the deadline may depend on the license date, which is the case for Luxembourg, but it can also be the filing date, which is, it seems, is the view of the BaFin. So we have difference between regulators there. Then there are fields that are considered as being mandatory, others that are conditional, and some others that are optional. But we have seen in practice that some of the optional fields are not pure options, meaning that it's not only the AFM who is deciding whether to populate it or not, it's more a condition. If we take the example of liquidity risk section, this is one of the main sections of the directive, so there is no reason why it would be a complete option to report on that. But on the other hand, we know that if you look at the XML structure, it's mentioned that it's optional. So from my point of view, it's more a condition than a pure option. So we are waiting for the regulator to come back with clarification on that. Then you have risk measures like valid risk and so on. For the moment, we don't know yet if they will be required for all AIF. The reason being that this is part of an opinion that has been provided by the ESMA to local regulators. So local regulator will have to define if this is binding or not. And then for geographical focus, it's still part of the opinion of the ESMA that has been sent to different regulators. You will be required to apply transparency on the underlying, depending on what will be the opinion of the local regulator. So we know that we see that we still have questions. Regarding the deadlines and for the production of the reports, I will not go through each line. This is just a different scenarios depending on when you will get your license. So just to summarize quite quickly, we know that from an operations standpoint, we will have challenges because this is definitely not something that should be underestimated. By having spent quite a lot of time with clients on this, there is an intense operations challenge there. And the second point that we have to consider is that the deadline is not that far away from us. So we need to go fast on this topic. So now I'll leave the floor to Bruce.
Actually,
thanks,
Benjamin, thank you so much. And I'm sorry, Bruce. It's Neil here, your moderator from bobsguide, and I think it's probably just worth reading out the poll results if that might be of interest to our listeners. And then I'll hand over to you, Bruce, if that's okay. So just so our listeners are aware, the first question about how prepared do you think your firm is for meeting AIFMD requirements. Fully prepared were 14%, somewhat prepared were 67%, and not at all prepared were 19%. And just in case that's of interest to our readers, the second poll in Benjamin's segment, which was what is your top concern for the next 12 to 18 months? And the standout result there was meeting regulatory deadlines at 66% and then reducing operational risk at 19%. The other findings were basically not in double figures. So apologies for butting in there, but I thought our listeners might like to know those results. And Bruce, please, maybe you can take over now.
Thanks, Neil, and welcome to all of our participants today. I see we have 127 people online, and certainly a big shout-out from New York, where I'm the Senior Vice President at Axiom Software, and spent the last 2.5 years working with our asset management clients to deliver solutions for the filing of Form PF and the filing of Form CPO-PQR, both similar, although less, I think, less detailed reports than are required to meet the AIFMD challenge. And I'll speak briefly about that now in my comments. So certainly, the challenges are broad, as both Benjamin and Jennifer have mentioned. The data challenge is I'd say on the I'd agree with Benjamin. It's on the high side in terms of difficulty factor, and only related to Article 24 reporting. Certainly, the published guidelines are current. They've been amended twice since October of this year. We are tracking those changes. They include a broad range of technical specifications around the data. So, in terms of my sense of the data elements, broadly, there are many, and we include their investor data elements, exposure, risk, and counterparty, borrowing exposures, and this unique leverage section that they've added for 24/4. And when we look at our gathering together our data, I'll spend a few minutes talking about that scoping component that both Jennifer and Benjamin touched on. one unique topology that's been added for, or I'd say amended, for asset exposures that drives fully 20% of the responses in 24.1 and 24.2, the area that Benjamin commented had 300 relevant data exposures. Then we'll look at some of the unique calculations, and again, both Jennifer has touched on AUM and commitment basis leverage calculation, both substantial changes to what the U.S., at least the U.S. asset managers have had to comply with for Form PF. And finally, just touching on some of the requirements systemically to enforce a certain confidence around certification and ongoing changes to the report, like what we would refer to as versioning here, and analysis that allow management to have a control over what's been shown to the regulators in advance of the regulatory filing. So the first area, just in terms of a data challenge, I'd say, and as Jennifer's mentioned, this is perhaps the level one is to find all of your AIFs and AIFMs that are captured by this particular reporting requirement, document those requirements. We've seen that typically handled in our compliance divisions of our various asset manager clients, and then capturing some key attributes associated with those funds and AIFMs that drive the requirement to do this reporting. And here I've shown that those attributes are fund type and limited primarily to, as Jennifer has mentioned, all funds have to report, but PE funds have this unique, PE funds and real estate funds have this unique aspect of reporting once per year as opposed to gravitating down to the more granular reporting on quarterly and half-yearly basis. Then AUM, which is uniquely defined and drives primarily your frequency of reporting, and then whether or not you're marketed or not in the EU and whether or not you're highly leveraged, it drives the additional reporting requirements mentioned by my previous panelists. So here, just in terms of AUM, there's a broad definition of it offered in a couple of the precursor documents, including EU delegated regulation documents dating from 2011, and also in the final report documents that you see on their websites. And just to rehash, you have to actually add into your AUM the derivatives converted into their equivalent positions and underlying values. And this is broadly defined in Annex 2 of their documents that indicates the conversion methodology for each derivative type. The second data calculation that's required is this ratio of exposure to NAV, their leverage ratio, if you will. And it's required that you do the calculation on two bases, but the commitment method is used to determine whether or not something's substantially levered for purposes of whether you have to make that extra requirement, reporting requirement under 24.4. And there's again a definition of that both in the original AIFMD directive and also in the definitions provided and guidance provided. The second area I'd like to touch on is this exposure typology that adds some levels of granularity to exposures and drives the answers to multiple questions. In fact, I mentioned previously 20% of the questions, fully 20% of the questions are added to trace the roots to this topology. And on the top left side, they've added, from what we know in our Form PF experience, the macro asset type to and asset type to this topology. They've added the macro asset type, excuse me. So, and we think that's we think it's a good addition to broadly define the level of exposures and in a better way than what we have seen heretofore in the U.S. requirements. And just as a matter of an example, the macro asset type could be securities. There are several. And the asset type could be a sovereign bond. And in the sub-asset type could be a EU member bond. These are, again, available, these topologies by asset type, sub-asset type, macro asset type are available in their instructions. And what's interesting is they've combined these hierarchies with attributes including market traded, position type, long, short, geography, and instrument. And then they've asked for reporting based upon these attributes by granularly looking at instruments and grouping them by market traded, sub-asset type, and position. We see this type of reporting requirement as a high degree of difficulty, requiring control over your tagging at the basic inventory level, ensuring that you have validity in all your geographic assignments, ensuring that you have validity in all your sub-asset, asset type. The data has to be exposed to input controls to ensure that this data going through isn't generating incorrect results at the end of the process. And also to be able to look at the end of the process and be able to drill back into the core data critical to being able to deliver a successful resolution to this reporting challenge. Next, I'll just touch on what we would call our old PF slide here, just to touch on a couple of issues. Firstly, that when we do data projects and reporting projects, we drive elemental pieces depending on what our asset managers' clients would like to see at the in terms of deliverable to their data set. And so Benjamin has commented about the different types of data readiness and data sets from the asset managers he deals with. We see the same type of thing. So we provide, at the front end of every reporting project, we provide the ability to give the data in native format to a solution, or in asset management projects, we've actually provided an enhanced data attribute dictionary to be able to track where we're getting all the answers that we need to enforce the discipline around getting the correct answers into the front end of the process. Then we are providing these basic, for instance, exposure foundation rules and tagging requirements, and finally reporting that includes the form and a management reporting that might be required, and certainly exception reporting based upon this XML schema that AIMA has promulgated. And it's a detailed XML schema that allows us to drive many different controls. I think at the end of the day, Foreign PF and the existing CPO projects here, we see several thousand of these data point accuracy validation rules, and we see certainly a multiple of that with the level of granularity required for AIFMD reporting. And this perhaps troublesome issue or extreme challenge is that it's being farmed out to almost every fund. So we stop for a poll question here. What kind of risk management and compliance systems do you currently use to meet or plan to use to meet your AIFMD requirements? And there are three choices. Certainly, while we're having that poll question, I had just a couple of issues to comments about our experience with Foreign PF and data. And this is, I think, every session I've been to in the last 6 months here in New York, everyone talks about, just to rehash the fact that the data set that's required to answer AIFMD, approximately 70% of the data that's used to answer Form PF questions is reusable, in fact, to answer, if it's properly tagged and properly sorted and properly joined, it's reusable to answer the 24 reporting. However, only 20% of the answers we've come up in Form PF actually directly map to the AIFMD. And so I think my prior panelists have commented extensively on this, but just in terms of a couple of details, and there are many examples to pull from. But here is an example under, I think question 12, for instance, in Form PF, requires you to disclose your borrowings, and in their FAQ, they informed us all that you wouldn't have to include this particular exchange-traded derivative embedded borrowing. But here in 24.2, under AIFMD, they've asked for this particular value of borrowings embedded in financial instruments. Then another example, which is relevant to our PE groups, our PE funds, that this concept of controlled portfolio company exists for Form PF respondents under Section 4. But in question 290 to 293 of 24.2, they're looking for the gross exposure of financial and or legal structures controlled by the AIF for all fund types. So they're not restricting it only to the logical PE and real estate fund type entities where there are acquisitions of companies. They're extending it to every fund. Just back to, so the poll question is completed, and I'll leave that to Neil to review at the end of this presentation. The last area I just want to touch on, we've had a lot of interest in looking forward to what type of scrutiny the various NCAs would have in Europe against what the current SEC exam priorities are for U.S. investment advisors. So we thought this was relevant because obviously the SEC is through 1.5 years of reviewing Form PF data, and they've really embarked on a focus to regulate or review hedge funds, and they see these systemically as risky. And they've switched really to being a watchdog over what consumers see. So there is aggressive scrutiny around marketing materials and any kind of misstatements there, or any difference between the marketing materials and what shows up actually in their Form PF reports. They're using analytical tools to evaluate returns. I know that one of the big four firms here in the United States has helped them with that. In fact, they helped them devise those tools. So we're seeing real focus on compliance, and I think this kind of concept, I've heard this before, tone at the top. So whatever the overarching firm is doing at the top, they're evaluating whether or not compliance runs through the organization. It's certainly AIFMD. I could see that being the entire directive and the entire requirement for compliance, the conflict of interest, the compensation disclosures, the entire directive really requires a complete focus on compliance from the top of every AIF. Finally, just in terms of a couple of look-forwards, there are, in terms of 2014, risk-based asset verification process is being confirmed. And one of the things they're looking at is whether or not you're meeting your custodial requirements. Certainly the AIFMD has very aggressive custodial requirements for each fund that you are required to comply with. And so similar efforts there, I expect. And certainly conflicts of interest issues being focused on, including undisclosed compensation and investor preferences. Now, just in terms of wrapping up, I think that whenever you're embarking on a process to acquire or develop something that is going to ensure accurate reporting, which is what this Article 24 requires, you need to look for a flexible and scalable solution that spends a fair degree of time or has a fair degree of substance around the data quality. Certainly, we're looking for data to be, the ability of data to be vetted, exposed to compliance lists, integrity of that data, to ensure that it's introduced in a way that is complementary to what ultimately you want in your reports. It's certainly any solution that would be acquired for this purpose should be or have the ability to enforce certain performance, because we see a high degree of a high volume requirement, the number of funds that have to report, the fact that AIFMs need a report, and the AIFMs need a report in a different, perhaps potentially different from AIFs in terms of different frequency. The concept of all the data tagging that has to take place. We're looking for a fairly high volume in this application, and then we're looking to enforce the discipline around being able to drill down to the lowest level of detail that the asset management firm has provided, either through their administrator or through their own shadow books or through an outsourced vendor that provides their shadow books. And finally, I think although the directive mandates that there should be requirements for NCAs to be able to report in multiple languages, which I certainly demo tested this with several of the European languages to ensure that the form can be produced and in multiple languages. So that concludes my comments. I'm certainly happy to pass it over to Neil now to conduct the question and answer session. Thanks for your time and attention.
Okay, well, thanks very much there, Bruce. And as mentioned, just to recap on the polling question that you asked there. So the question was, what kind of risk management compliance system do you currently use to meet AIFMD requirements? And the results for our listeners were a third-party vendor solution, 52%, a homegrown solution at 38%, and perhaps worryingly, none at 10%. So that's just to let our listeners know the poll. And as mentioned, now we can move into our Q&A session. And thank you to all our speakers. So I can see we've got several questions already, but if you do have a question, please just type it into the box on your console, and I'll try and put it to the panel, time permitting. So we've got time probably for a couple of questions only, but we've got one here about AIFMD's implementation time frame, and perhaps this has been referenced in the presentation already, but crucially our listener wants to know if the panel thinks the industry is ready. So let's start with you, perhaps, Bruce, whether you think the industry is ready.
Sure, Neil. I think that, so readiness defined by time to deliver. So we're at sort of the 12th hour. I don't think that it's impossible to comply before the end of the transition period in July, but it's a steep hill to climb. The directive's broad. It is pervasive in terms of disclosure and requires broad compliance perspective. I know that both Benjamin and Jennifer mentioned they thought that it would be a steep curve to get up, but not unsurmountable. And in 19%, I noticed in one of the original poll questions that 19% felt that they weren't prepared at all. So maybe we take it I think there's an element that certainly of groups that are not prepared at all, but I'd say across my clients in any event, they're focused on it. They're looking for ways to enhance their data sets. If they're doing Form PF, they're looking for ways to comply. So.
Interesting. Okay, well, thank you, Bruce. Maybe we'll throw it open to the panel. And there is another question here just about individual EU member states and their readiness. So, Jennifer, or what do you think there? Perhaps Benjamin.
I think the answer on member states varies from member state to member state. Crucially, all of the sort of fundraising jurisdictions are going to be ready, and certainly all of the main fund management jurisdictions. There'll be a number of countries, however, where they won't have transposed by the July 2014 end of transition period. But those member states are not the ones that one typically associates with asset management.
Okay, interesting. Perhaps a related question to that. We've got a question coming in about jurisdiction turf wars and whether regulatory arbitrage between the EU member states in respect of reporting might come to pass. So maybe that's something that Benjamin or Jennifer might like to take again. This question, if European harmonisation will really happen.
Well, certainly member states are interested in increasing their market share among asset managers and among funds. And if there's some view that making things slightly easier within the AIFMD framework gives them a competitive advantage, maybe they'll take advantage of that.
Sure. Yeah. Well, and as you said yourself, I mean, it does vary from market to market depending on the industry there. So perhaps that might come into play as well. So, all right, thank you. Just as a supplemental question, perhaps, about the global harmonisation picture, what does the panel think about that and the prospects for global harmonisation in this area? Jennifer?
Well, I think it's Bruce, Neil, and I could offer one perspective that I picked up was
Speaking
that
from New York, it would be great. So thanks.
One perspective I picked up was and it's kind of fearsome, but the kind of concept that AIFMD is a broader reporting mandate, has more compliance elements to it. Then it may end up being a global template for the enhancement of asset management regulation across other jurisdictions.
Mm-hmm. Okay, all right. Well, I mean, I think our poll questions actually give our listeners a good indication as well as readiness or otherwise, as you alluded to earlier, Bruce. So let's move on to another question that we've got coming in. It's a query about the integration challenge and how easy or otherwise integrating the new regulation into existing systems will be. And Bruce, perhaps that's another one that you would like to take. Yeah, just really on the technology as much as anything, and whether there is an integration challenge out there that needs to be overcome.
I think from our perspective, we've built a platform on the data level to integrate at metadata data sources. We've also built a platform to take concept of form-ready data. So multiple approaches dependent on what our asset management clients are looking to enforce. I certainly see it as it's an opportunity to address their requirements as they bring them to us, and we don't think that it's insurmountable.
Maybe if I can just one thing here, so it's Benjamin speaking.
Sure, please.
I think that one additional challenge that we should not underestimate related to that, I mean, integrating solution is one thing, but I also think that one of the challenge that is happening now is to make sure that all the data that needs to be disclosed to investors, or to be disclosed in the financial statement, or to be disclosed in prospectus, or to be disclosed to the regulator, or then going for EMIR requirements, if we're looking a bit further, and there are other requirements like that. The main challenge is to ensure consistency between all this. One change on the one hand may impact all the rest, and how do you keep track of it? And I think that this is going to be a serious challenge, and matching it would also be very difficult from an operational standpoint.
Interesting, yes, and so many different countries over here in Europe, that is always a constant issue with France and Germany and the UK and all how they're going to interact. So, okay, that's great. I'm conscious, actually, we're just running out of time now, I'm afraid. We do have some more questions, which perhaps we can hook up offline. But I do like to give the panel opportunity, really just as a final point, whether they would like to add or stress anything as we come towards the end of this webinar. We've only got a minute or two left, but are there any final points or stresses that the panel would like to make?
I think from the point of view of this, looking at this AIFMD directive strategically as an opportunity to enhance the infrastructure required to answer these questions, be able to be in a good position to comply with UCITS 5 and be in a position to answer the financial statement disclosures and investor disclosures from the same data sets is perhaps a high-level takeaway from this webinar.
Yeah.
And one additional thing also is probably a lot of entities have spent time to prepare their filing documents for AIFMD, and a lot of them are still continuing to do that. But the thing is that the reporting requirements are not required to be met to be able to file. But they should not be underestimated, because as soon as you get your filing, then next caller is the one for the reporting. And I'm not sure that with 2 or 3 months you will be ready. So don't wait till you have your filing to look at the reporting requirements.
Yeah, I think that's probably sage advice there, Benjamin. And thank you very much indeed to you and to all the panel. And as mentioned, unfortunately, we are now running out of time, so it just leaves me to thank all of our speakers and the sponsor today, Axiom, for a fascinating discussion, and to remind you all that the recording will be available on bobsguide and the poll results too. So thank you all for attending today, and we look forward to welcoming you to another bobsguide webinar in the near future. Thanks all, and goodbye.